Good evening and welcome. First of all, this video which I am going to shoot, or the video which you are watching, is going to be totally different from what I have done so far. It would be very irrelevant and I would say very Gen Z language. Now, there's this movie by Quentin Tarantino called Kill Bill. I am talking about Kill Bill Volume 1, where this character Ellie, who is also known as California Mountain Snake, uh, leads a black mamba to a person, and the black mamba bites that person, and she says a gargantuan amount of poison is delivered. And then she says, I always wanted to use the word gargantuan. So, the picture which you're seeing, and above the picture, it is written in Bengali, Shop Pakhi Mach Khaye, Naam Hoy Shudu Mach Rangar. Now, this is a Bengali proverb, which means all birds eat fish, but only the kingfisher gets blamed. The reason I say this is everybody scalps in the market. I mean, if you are scalping options, if you are scalping futures, if you are scalping cash, but scalping always gets a bad name. Even if somebody is scalping the whole day, if you ask him after a few days what kind of trade will you do, he will say, I manage delta, I harvest risk premia, I play on theta, I do a gamma cap and all such shit. But the problem is, end of the day, this person actually scalps, and scalpers get a bad name. So I am going to give an introduction to scalping in the Indian markets. Obviously, there will be 2 or 3 videos regarding scalping, and post that I will be showing you a system which will help a scalper to trade in the Indian markets. But the focus is, even if you do not take this software or this particular system from me, this set of videos will set you on a path where you can understand what scalping is, and you can make a scalping system of your own. That's why I am uploading these videos on YouTube. So the system is named ScalpEdge. Let us get down to what it does. Now, scalping is basically currently done in Nifty and Sensex options, where your success will depend upon quick execution. The quantitative tools which you have which will support you in scalping, and very disciplined strategies. Now, in India, if you try to scalp, the best place is the options ecosystem on Nifty and Sensex, which have weekly options. You can leverage volatility, you can use technology because there are a lot of very fast execution brokers and APIs, and you can use cutting edge indicators on TradingView for a professional trading edge. As a trader, I have been trading and I have been coding systems initially from the year 2000-2001 on Metastock. Then we shifted to AmiBroker sometime in 2014, and from 2020-21 I have shifted to TradingView. The amount of coding support TradingView provides is unparalleled. I mean, if you compare Metastock and AmiBroker with TradingView, those were basically Jurassic Age. Now, for traders, quants and strategies, practical setups, if you can use in scalping, it will help every type of trader who trades. Now, what is scalping? It is high frequency, short term. Scalping involves making dozens of trades per day, targeting small price moves and booking frequent tiny profits. So if you are a scalper, you are actually trading at least 10 trades a day, if not more. It could be 20, could be 30, could be 50. So your wins are basically tiny, but your volumes are massive. So if you are trading like say 300 Nifty options, and if you are trading that 20 trades in a day, your total volume is like 6,000. On any trade, you are not attempting to get 100 points. You are getting 5 to 10 points per trade. So you are never chasing a large trade. You are always going for small trades, small profits, small losses, small profits, small losses. So in order to do this kind of trading, 2 things are absolutely crucial. One is discipline, one is speed. Both are equally critical because this requires razor sharp focus, rapid execution, and very strict risk management. If you follow these three, you will survive, else scalping is not for you. You can go for LFT, low frequency trading, you can go for swings, you can go for deliveries, whatever else. But unless you are disciplined and you are fast, scalping will not suit you. So please understand that even if I provide a very robust scalping system, it might not suit you. Okay. Now, why do we prefer the weekly options? They offer the highest liquidity, tight spreads, and rapid price movement. What do I mean by highest liquidity? If you see the Nifty weekly options, in terms of volume, they are the biggest compared to futures, compared to stocks, compared to anything. Tight spreads, that is, if you are trading Nifty options, the spreads are probably like 5 paisa. So if an option is trading at 120, you will probably get a bid ask of 120.15 and 120.20. So whatever volumes you trade, you are almost always 99% of the time guaranteed a fill. Number two, rapid price movement. If you are trading the ATM options, which is kind of like 50 delta, if the index is moving 10 points, that is moving 5 points. So if you are trading a say 100 rupee option and it goes to 105, it's a 5% move. If you are trading a 500 rupee stock, for a 5% move, that will require 25 rupees. Doesn't happen every day, doesn't happen in 5 minutes, doesn't happen in 1 minute. But Nifty, as you know, can move 5 points. An ATM option can move 5 points in minutes. So rapid price movement. Now, other than Nifty or Sensex, can you trade other things? Obviously, you can trade stock options or futures. But there, very selective scalping is possible only if the stock option or the index future is liquid. And volume and your spread must justify that approach. And once again, if you're trading futures, in Indian markets, the transaction costs are pretty huge. In options, it's low. So the transaction cost also plays a big figure if you're trying to scalp. Obviously, a broker comes in handy if you have a kind of 10 rupee per trade, 20 rupee per trade, or even a fixed brokerage in a month, your cost actually decreases. Now, common scalping strategies which you have seen are basically if you trade the ITM, ATM or OTM options, rapidly enter and exit as the index moves 10 to 15 points. 6 immediate price response and tight spreads. This can be done manually. There's also something called a bid-ask spread scalping. Place buy orders at bid and sell at ask using limit orders. Profit from micro moves in spread works bakes in high liquidity. Now this is only done by HFT and algo, cannot be done by us. Third is delta neutral short gamma. Write both ATM call and put options. Scalp the legs for incremental profits while managing exposure. It is also known as gamma scalping. This can only be handled by an algo, almost impossible to do this manually. Last, order flow or momentum micro trades. Exploit shifts in open interest volume and rapid price action to catch micro trends and reversals. This can be done manually. Now what I'm going to show is basically this fourth particular point. Okay, just keep this in mind. We'll go to this in detail. Now if you are going to scalp, you need a very fast platform. So top Indian brokers are Zerodha, Angel, Dhan, Fires. This is obviously not an exhaustive list and I am not promoting any broker. But please see that the broker has lightning fast platform and very low charges. You can use hotkeys, you can use APIs or algo trading bots or whatever. So if a broker is allowing all this, you can use that broker for scalping. So if a scalper is using tools, he will be using option chain scanners, level to depth, Greeks for real-time signal generation and risk control. Last, if you are using custom indicators and tape reading, deploy TradingView scripts, stick charts and tape reading tools to track microstructure shifts in price and momentum. So the scalper's survival toolkit. Number 1, tiny target, tighter stop. Scalpers work with 0.1 to 0.5% targets and even smaller stop losses. Every tick matters. They will never carry their trades overnight, so there is no overnight risk. All trades are intraday. Number 2, disciplined position sizing. Keep individual trades small to enable dozens of entries daily. Minimize drawdowns and preserve capital for new opportunities. So if you have 1 lakh rupees, you see a scalp coming up, you don't buy 1 lakh rupees worth of options. That's your surest, I would say, way to get a blow up. You will buy probably options worth 10,000 rupees, risk 1,000 rupees on that particular trade. Number 3, strict risk rules, predefined loss limits, fast exits, and the willingness to cut losers instantly separate survivors from blow-ups. So here, more than how much profit you get, it will matter how fast you cut your losses. The best time to scalp in India, 9:15 to 10:15 am, highest volatility and volume, ideal for catching rapid price discovery and micro trends. Closing session 2:30 to 3:30, last 60 minutes see volume spikes as institutions adjust, creating fast moving opportunities. Last but not the least, Thursday expiry events. Thursday for Nifty, Tuesday for Sensex, that is going to change. Tuesday will be Nifty and Thursday will be Sensex very soon from September. So weekly options expiry drives exceptional volume and wild moves. With scalping opportunities peaking, you will get multiple scalping opportunities in a day. Profits can be big. Out of 5 days in a week, 2 days you will get these opportunities on a Tuesday and a Thursday. Compliance, cost and broker choices. Scalping profits are sensitive to brokerage taxes and slippage, so use a discount broker and watch your per trade cost. SEBI compliance, trade only with a SEBI regulated broker, ensure proper KYC, margin usage and regulatory adherence to avoid disruption. That is, don't go for bucket shops or crypto exchanges which are not monitored and they can just run away with your money at any point of time. Number 3, track execution quality. Monitor fills, that if you are hitting a trade at 120.40 paisa, monitor that you are getting a fill at 120.40 paisa and you are not getting filled at 123. Slippage, how much slippage you have when you are getting into the trade or cutting the trade. What are your rejection rates? Automation will help, but human oversight is still critical for quality control. Now this is a kind of graph which will give you a matrix for Indian traders. For a scalper, a holding time sits seconds to minutes. For an intraday swing is 30 minutes to few hours. We already have an intraday swing system which is the VWAP navigator with quant. Positional is days, weeks, that's a different story. In scalping, your trade volume, that is the volume you have traded till the end of the day, is very high. Intraday swing is moderate, positional is low. Scalping will target 2 to 10 points, intraday swing will target 20 to 50 points, positional will target 100 plus points. Risk level is scalping is very low because in a minute if you see the trade not going for you, you will get out of it. So there is no overnight risk or gap down risk. Intraday swing is medium, positional is obviously higher because you are taking an overnight risk. Toolset requires scalping, you will need a fast platform and quantitative tools which give you a decision. Intraday swing, you can use advanced technical analysis charts, positional analytics, TA or fundamental and news. Unique advantages of scalping Nifty or Sensex options. Low capital, high leverage. Option scalping allows participation with small amounts. So even if you have 10,000 rupees, you can participate in the options market. It is amplified by the exchange leverage because any options is basically a derivative and a highly, I would say, leverage product. Because let's say an intraday, if you are buying a Nifty option at 100 rupees and if Nifty lot size is 75, you are actually controlling, let's say you are buying it at 100 and the lot size is 75, so you are buying an option of 7,500 rupees, 7,500 rupees, but Nifty is quoting at say 25,000 and 75 into 25,000 is your notional cost. So with an option you are actually controlling a much bigger asset, that is the leverage, right? So obviously leverage will work both ways, profit will be high, loss will also be fast. So it has, I would say, it's a two-way sword kind of. Number 2, constant opportunities. Weekly options provide fresh setups daily, no need for overnight risk taking. So if you're trading weekly options in Nifty and Sensex, every day is a new day, every day you get opportunities. It's not that if you don't trade today, there's a big opportunity you have missed, tomorrow you will not get that opportunity. It's available every day of the week. Number 3, easy to automate. So if it's frequent or repeatable pattern, then API enabled brokers will make your system and automate it. And as a retail, as of now, you can participate in automation also. So technical indicators in India, people what they now use to scalp, they use EMAs 9, 13, 21, 50, 20, whatever. They use VWAP, they use super trend. So they use it for trend detection and dynamic crossovers for entries and exits. So maybe they will use super trend to find out whether the market is bullish and bearish, then use a moving average crossover to trigger trades. That's what a lot of scalpers do nowadays. Number two, if you are a bit more advanced, you will get into Bollinger Band and RSI. So you will put in Bollinger Band, see where the upper or the lower level is hit, use a RSI overbought oversold level, and then kind of walk for mean reversion. Or if Bollinger Band is going through a narrow kind of congestion, watch for a breakout. The third one is order flow and tape reading, real-time market depth OI volume spikes, providing crucial microstructure signals absent in lagging indicators. Now I have marked this in yellow because this is what we are going to use, not the first two. Why not the first two? What are the limits of conventional tools in micro time frames? That is when we are scalping. Number one, this is high noise and low signal. Micro time frames are dominated by random moves and market microstructure. Indicators struggle to filter actionable signals. Second point, and this is the biggest point, all indicators are based on past data. By the time they signal, the opportunity is often gone. Backtests rarely match live reality. Let's say you are using MACD, which is basically a difference between a 26 period and a 12 period EMA, and you are trading, let us say, on a 3-minute bar. So if you are using a 26 period EMA in your calculation on a 3 period bar, it is like 75 minutes, 1 hour, 15 minutes back data is being used in your calculation, and you are trading for the next 5 minutes. Does it actually make sense? No. So if you are using technical standard indicators like MACD, moving average and RSI, it doesn't make any sense if you are trying to scalp. Number three, invisible context. Indicators miss real-time market events, news and regime shifts. HFTs exploit predictable patterns, diminishing edge. This basically means if you are actually using indicator, what is happening in real time in the market, a news hits, and if you are using a 26 period moving average, it has like kind of 1/26th of the weightage. By the time you realize market is going up, it has already gone up by a few percentage points or maybe 100 points. Then you see, okay, now the indicator has turned. So actually indicators, technical analysis indicators are all good if you are using on EOD, or if you are using for swing, or if you are using for LFT 2-3 trades, intraday swings. But for scalping, indicators, TA indicators classically are practically useless. So now let's come to what we are going to do. We are going to use something called a congestion quant indicator. So we will be mapping zones of opportunity in option scalping. We will detect a price compression. So the indicator actually quantifies volatility clustering to pinpoint congestion zones, areas where breakouts and liquidity pools emerge. On your right hand side, you see a picture where certain points are marked in a rectangle. That is where a congestion takes place. So this indicator actually finds out where a congestion has taken place, marks that in real time, and then you can get ready that when market is breaking out of this congestion, I will go for a trade. So it actually filters noise and anticipates move. If you see this picture, the first rectangle which is marked is basically noise. Market is not doing anything. So when market is in a noise phase, you do not trade. Only when it gets out of noise, a trend starts, then you trade. So this indicator actually kind of focuses on your chart and gives you statistically significant setups on which you can actually focus to trade. Okay. Number two, it is adaptive to volatility. It continuously recalibrates to market conditions. We will see this later when we will go to the indicator. Next, we have an indicator. We actually have two indicators in the system. We have something called a live OFE, option flow engine. So it scans price, open interest, volume, bid-ask, IV to track evolving smart money flow and volatility events. We will go this in detail a bit later. It spots aggressive flows, identifies large buyers and sellers and unusual activity, providing an early heads up before price reacts. It basically detects whether more puts or more calls are being sold. Again, we'll go into this in detail a bit later. Number three, adaptive and automated scanning. It constantly reviews all strikes and expiries for new signals, adapts to daily shifts in sentiment and market structure. So, if we add this both, congestion is the focus zone where compression is going on. After that, we will trade. Option flow engine will basically tell you what is the signal, whether you're bullish or bearish, which side the flow is going on. Number three, when both combine, you get an edge, which is context aware and robust. So by acting only when both tools agree, the system maximizes win rate, minimizes noise, and adapts to changing regimes. So what is our takeaway? Structure plus flow is basically edge. Structure is basically the compression zone, flow is basically the options flow. So this will provide you success when you understand market structure, when you have fast execution, and you see real-time order flow on your chart and not lagging indicators. So these indicators basically tell you what is happening now. It doesn't tell you what happened 26 periods back. Second, it is adaptive and context driven. So these two indicators basically adapt to market conditions, reducing whipsaws and maximizing edge across regimes. Number 3, execution wins over prediction. So statistical and operational edge comes from robust workflow and rapid decision making, not guessing market direction. So when we see these two indicators, it will give me a robust view what is going on in the markets. I will not guess मुझे लगता है market बढ़ेगा कि घटेगा, ऐसा कुछ नहीं है. Whatever the two indicators in combination say according to the rules, you trade according to that. So any scalper using ScalpEdge, this will automatically detect which time frame you should trade, 1 minute, 3 minute or 5 minute, because a lot of scalpers or a lot of day traders ask me, sir, what time frame should I trade? 1 minute, 5 minute, 15 minute, 30 minute. You will see this indicator telling you which time frame you should trade. Number 3, regime is detected through quant methods. Other than this, we have something called a regime, trending, noisy or normal. So if it is a normal regime, you can scalp. If it's a trending regime, you hold your scalps a bit more and you kind of fade moves or stay away when it's noisy. So the OFA automatically detects the current ATM and analyzes ATM and nearby strikes, providing a directional view. End of first, I would say, PPT. Let us come to the indicators now. The first indicator which we will use is something called congestion and analytics. So the funda is here, if you are not even using my indicator, you can use this concept to build your own. Markets alternate between congestion and trending phases. Truth of life. The line should be written in Quran, Bible, Gita, Tripitak and all other trading books. Understand that the market by nature is cyclical. Okay, so it will alternate between congestion and trend. Number 2, focus on actionable edges in each regime. Identifies opportunities by adapting trading style based on whether the market is ranging or trending. Because if it is in a range, you need a different strategy. If it is in a trend, you need a different strategy. Number 3, objective. Build robust regime-aware strategies. We'll see this in detail later. So identifying market phases for scalping. Congestion, sideways price action with a tight range. Market equilibrium between buyers and sellers leads to consolidation zones, often forming rectangles and triangles on chart. On your right hand side, you see a picture where the congestion zones are actually marked with the high and the low of the congestion zone in a level. So if you see clearly, after this congestion zones, actually a move comes, right? Trending, sustained movement in one direction post breakout. So after we break out of these boxes, a decisive move takes place in a particular direction. So trading implication is avoid trading while in congestion, focus on when we are outside congestion and in a trend. So scalpers should always trade breakouts or establish trends to reduce false signals and improve edge. Now this indicator also tells you 3 stages of volatility. One is normal volatility, where you have predictable swings, stable conditions, risk is manageable, signals are reliable. One is high volatility, very sharp and unpredictable moves. Trends become explosive, opportunities and risks both surge. Low volatility, sluggish movement, rare breakouts. When this happens, if you are an option buyer, your best option is to stay away from the markets. So recognizing trending, normal and noisy states. Trending is clear directional movement, strong momentum. Normal is moderate swings, lack of clear trend. Noisy is choppy, erratic, frequent reversals. So choosing the right time frame for scalping is another point. What time frame chart should I trade? Now this indicator, depending upon the quant analysis, picks up 3 particular time frames to trade. The basic time frame is 3 minutes, because a lot of studies have been done to trade the Indian markets as a scalper. 3 minutes is very optimum. So what this system does is it picks up the volatility. If volatility is normal, it will tell you trade the 3-minute chart. If there's a very high volatility, it will ask you to trade a 1-minute chart. This will be automated. I mean, it will tell you what time frame to watch. And if it's a very low volatility, it will tell you switch to 5-minute chart. It will come automatically through the indicator. There are three different inputs in the indicator. One is something called a zone window, sets the look back period for price clustering. So shorter windows will catch quick consolidations, longer windows will be more persistent or significant. Number two, how congested are we? Degree of tightness measures price compression relative to volatility. Lower values mean only ultra tight zones are detected, higher values will looser, capturing more signals but with more noise. Minimum duration filter, that is how many bars this particular congestion should persist to be called a congestion. It could be 2 bars, could be 10 bars. So if I say it is congested for 2 bars, doesn't actually make any sense. But if I say it is congested for the last 5 bars, it does makes any sense. So this is what you will see on the indicator. Zone window, that is congestion, degree of tightness, minimum bars in that zone, how much it has stayed. So if you want to fine tune, tight window, tight degree, short duration detects rapid, ultra tight micro consolidations best for high frequency scalping but can be noisy. Long window, tight degree, long duration filters are rare, powerful base breakouts. Looser degree, more adaptive, more signal. Loosen the degree to capture opportunities on slow or range bound days requires more filtering. Now what I will do is, you have seen a lot of theory, let me just show you an example. Now this is your congestion zone indicator, forget the OFE as of now. Yeah. And forget the labels as of now. Now everything is manipulated, can be manipulated from this particular window. So what I was saying was, this is today's market. We can see yesterday's market also. Let us see yesterday and today's market together. Forget this as of now. We are just focusing on the congestion zone indicator. Yesterday was pretty range bound cool and today was pretty volatile and trending. So what I want to say is, let us say I am coming to the inputs. Now these are the default inputs: 5 period zone window, 2 period tightness, 3 period minimum bar. Now if I say degree of tightness is 1, your signals will decrease, it will become much more accurate, I would say, but much more rare. 1. Okay, no signal, there should be some signal. No, almost no signal. Let's go to 3 minute, which is the basic. This will be actually 1.2. Nope. 1.5. Yes, now we have something. Let us see. These are the zones which are getting marked. Now if I say this is 2 and this is 5. These are your scalp signals. And if I go back to basics, that is the default. I will just take this pain levels off so that you can see this is yesterday and this is today. So yesterday market was a bit of boring. So if I do this, yeah. So these were the signals yesterday and today. And this was actually the last move where today probably 450 or 23, 25, 450 or 500, one of those calls went from 8 to 55. This was that move which went out of the congestion. So the reason why I'm saying this is, you need to change this and make your view, because it is not necessarily you will be chasing only Nifty. Let's say you are chasing Bank Nifty. So here what I do is I go back to 3, quite a few signals. there are pretty much more signals. So if I want to reduce this, let's say I do this 1.5, very tight. See, I still have signals, and these are pretty good scalps. Now let us say I want to reduce the signal even further. Let us do this as 5. I want to reduce it more. No, this actually totally goes away. No, not 8, 5. So my point is, these factors will depend upon stock to stock or index to index or even day to day, right? Today Bank Nifty was pretty, so I will go back to the default. So default, this is 2. This is 3. Yeah. So if I was trading Bank Nifty today, some trades in the morning, this was a congestion, this was a downside, this was a congestion, small scalp. Anyway, so that explains that I can use this particular window to set the system according to what I need. Let us go back to our PPT. So this is a summary. Zone window, if it is a low value, you will find small quick zones, more noise. High value, find bigger longer zones. Typical is 5 to 10 bars for scalping. Degree of tightness, low, only ultra compressed precise zones. High, many looser zones, more signals. Typical 1.2 to 2x for tight zones. Minimum bars in zone, even brief pauses can be noisy. High if persistent consolidation. Typical 3 to 5 for aggressive, 5 to 10 for conservative. So your best practice should be fine-tune parameters to current regime and asset. Adapt your detection settings daily. No one size fits all. Stay flexible and regime aware. So if you are a smart scalper, after every day, you will see which are the settings which are suiting the current market and set accordingly. So focus on quality, not just the quantity of signals. So don't go for that, I will manipulate this zone so that I get 50 signals in a day. Doesn't happen. If you get 5-6 good signals, that is better. So chase robust setups over minor moves. Number 3, review and iterate strategies regularly. Analyze post-market, this is what I was saying. Every day which combinations are working best in current conditions. Continuous learning is the key. This brings us to an end to the second PPT, which is the congestion zone indicator. We come to the last one, which is basically the order flow engine. So primarily this is basically an algorithmic option for analysis. It leverages advanced quantitative models to analyze real-time option flows, uncovering hidden market sentiment and positioning. This is what it does. So your decision making is basically data driven based upon live market data, open interest and price action. What we try to do is unmask institutional footprint, that what are the bigger players with bigger volumes, what they are doing. Now understand this market perspective. This is very simple, everybody knows, still we repeat. If you are buying a call, you are bullish. So if profit if underlying price rises, correct? So it is used by traders expecting upward moves like us, scalpers. Number 2 is call sell, which is you write a call. Profit if price remains below strike, favored when expecting stability or mild decline. So a call buy is bullish, a call write is basically bearish. Third one is put buy, bearish. Profit if underlying price falls, protective or speculative for downside moves. Number 4, put sell, which is bullish. Profit if price stays above strike, sellers earn premium and anticipate price support. Now concentrate on the first one and the fourth one. A call buy is bullish, a put sell is also bullish. But a call buy to get profit, the price has to rise. For a put seller, the price does not have to rise. It has to just stay at the same place. If it rises, well and good. But even if it stays at the same place, then also the put seller makes money. So if you are expecting an upside, and let's say you are expecting it 1000 times, selling a put will give you better money than buying a call. Because many times the upside will not come, price will remain as it is. In that case, the call buyer will lose money, but the put seller will actually make money. This brings us to our next theory. that in weekly options there is theta and seller dominance because time decay favors sellers. Weekly options lose value quickly as expiry nears. Option prices erode sharply with time. Seller advantage: option sellers benefit as premium evaporates, especially in mean reverting or stable markets. Buyers face a challenge. They need significant and fast price moves just to offset relentless time decay. Now, Indian market dynamics says weekly options flow is dominated by sellers who shape narratives and extract value from rapid theta decay. How this algo detects? It detects rapid premium erosion because weekly options lose swiftly, rewarding sellers with quick premium capture. Sellers will exploit theta decay at ATM and nearby strikes because ATMs has the highest theta. Buyers, as I said, will face dual headwinds. So our quant algorithm will detect seller footprint by continuously monitoring seller activity and market structure, showing to you what is their directional intent. So up moves are aggressive put selling. So what we have seen with data, you will see now that any up move more than call buying is actually marked by aggressive put selling. Okay, it provides support and absorbs downside risk. Down moves are kind of preempted by aggressive call selling dominance. Bearish moves often coincide with heavy call writing, capping rallies and signaling resistance. So seller intent signals direction. So monitoring seller activity across strikes reveals the likely direction of index moves. Quantitative validation, real-time tracking and statistical analysis of open interest and volumes ensure evidence-based decision making. Once again I repeat, it is not necessary you will have to take my software or my algo, but whatever I am saying, if you are trying to bid something on a scalping angle, these are the things you need to notice. Quantitative approach, step by step. Monitor OI and volumes, track real-time changes. Seller identification, use OI plus price action to distinguish between fresh selling and position unwinding. Statistical significance, compare live OI volume spikes with historical averages for meaningful signals. Relative strength and dominance, assess depth of put versus call selling. Bias, put selling greater than call is bullish, call selling is greater than put is bearish. So dominant selling set direction, put sellers drive up moves, call sellers cap rallies, quantitative monitoring is key. Now we come to the last part, which is PCR. PCR everybody knows, it's put call ratio. High PCR you need to be cautious, low PCR is bullish. PCR is very dynamic, you can track it intraday. We track PCR at ATM and nearby strikes and not the PCR of the whole chain. So market sentiment gauge means rising PCR, your people are adding puts, signals caution fear. Falling PCR is put unwinding. Watch intraday extremes, strike level monitoring, integrate with price action, everything is done by the algo. So it's a dynamic sentiment gauge where PCR provides actionable real-time insight into market fear, greed and position shift in real time for a scalper. It also provides reversal and momentum signals. It's critical for day traders and scalpers, but always use it with quantitative context, that is what price, OI and volume analysis are saying, then use PCR. So if I go to the indicator now, so let us delete this first and let us come to Nifty. Chart is of 3 minutes, yes. So this whole thing has two indicators. This is one, this is two. It will ask you for the current price. Today's market started at 25,300. I will just go through today's market to show you how this happens. Now sometimes you will see an error out here. What you need to do is, option code is Nifty, XTV expiry date. 25 is year, 06 is month, 26 is today's day, day of expiry. Strike step is 50, that is different between strikes. For Nifty it is 50, for Bank Nifty it is 100, etc. Last traded price, this you have to put when you are starting for the calculations. Okay, just to make it clear, let us just delete the levels. Yes, the reason I am showing this on a replay is there is one point which you will see when I replay. This indicator will give you an error. It is not an error, it's a trading view kind of lacuna. And I will also show you, if you get that error, what you need to do. Okay, this is your first bar. This is a 3-minute bar. Now this is telling you that on a volatility is high, Regime is trending on the right hand top. Time frame is 1 minute. Correct? Here it is telling you bearish flow is more call selling. It will be marked by red. Bullish flow is more put selling. It will be marked by green. Now on green you see a blue dot. I am coming to that in a few minutes. Again a blue dot. So what this says is you will see some green bars where there is a massive put selling. It does not have a blue dot, right? So what it says is if you have a green bar and a blue dot, this selling is actually statistically extremely significant. That is, some major put selling is going on in the markets. Major. This green bar is also put selling. Fine, it is normal put selling. This is major put selling. I mean, on that particular strike, on that moment, maybe for one call, 3 puts are being sold. People are selling one call, 4 puts. That's being picked up by the algo. Let's proceed. Okay, here you have an error. Why do you have an error? Because this particular rate is 317 and this particular rate is somewhere around 350. So in this single bar, ATM was 300, it jumped up to 350. So the ATM changed within this single bar. Whenever this happens, TradingView architecture cannot handle this. So what you need to do is whenever you get this, you just go ahead to the next strike. It could give 350, I am giving 400, just 50 point extra. Doesn't matter actually, because this algo will analyze on the ATM and strikes around it only. So whatever price you give out there is basically to analyze the chain. Your ATM will be analyzed correctly whatever price you put out there. Okay, let's proceed. As I said, massive put selling, and this bar 316 to 350 in a single 3 minute bar. This is now telling you switch to 1 minute. Yes, major selling is going on. Put selling, not future selling. Still no call selling. Not significant call selling is not there. So again market jumps up. Okay, this is a congestion zone. See, this got marked. This is a breakout. There was a massive put selling out here. This is actually driving this momentum, so I go long. Let's see how this goes. What happens if I went long out here? This is like 25,360. I went up to 25,380. So if this is moving 20 points, if you are an ATM option, this will move 10 points. So your scalping job has been done. This is now telling you regime is noisy, not trending. It is still telling you 1 minute. Noisy means if it goes up, it will sell off. If it comes down, it will jump up. It will not go in a single direction. There is no chance of short because there is no major call selling, because major call selling will be marked by red. Okay, there's this green triangle out here. What does it mean? It means based upon PCR statistical analysis, there's a chance market will turn from here. When this comes, what you do is the bar at which it comes, this is the bar at which it came, just mark the high of the bar if you are a scalper. If this high now gets crossed, go long, buy, call, sell, put, whatever. Yes. So if I had a buy order at this high, which is like 25,363, the bar where it triggered went up to 25,381. So 20 points in a flash. So if you are on a ATM option, you will get 10 points. Statistically significant. So this trigger which came out here on this particular green triangle buy, again this red triangle is a sell, so you need to sell below this low. This red triangle is a sell, you need to sell below this low. It didn't happen, and actually I'll be ignoring this signals in the first 15 minutes, right? Later in the day, they are very much reliable. Okay, another error. Let us go here. We are at 400. Let's say 450. Yeah. Okay, another point. If you want the indicator to load fast, this calculated bars don't keep it 1000, make it 100. Indicator will load very fast. This is 1 minute, regime is normal, volatility is high. So I will just keep it started so that you understand how this functioned. This is your put selling, call selling, bearish. From there the market comes down. Major selling comes down. Congestion box, significant buying, small loss. I'm working on 1 minute chart, okay. See, major selling, scalp down. Buying, this is where the buying takes place. Congestion, buying, market runs up. Congestion, buying, market will run up from here. Lot of buying. One signal, okay, selling out here, comes down. So before the market goes up, there will be green bars out here. Green bar, red, green, very strong buying. Wait. Yes. Very strong put selling. One way market. Wait. If you see this particular area, there has been no major put selling. There has been continuously, not major call selling. There has been continuous put selling. So what do you expect out here? Market will obviously go up. This is total put selling which is going on out here. Again major put selling. This is around 250. Wait. This is actually the trade where that call went from, yeah. Yeah, this one where we went from kind of 8 rupee to 50 bucks. So this is 310 and market kind of post 3-year expiry day, no use to trade. Now this was Nifty. If I go to Bank Nifty, let us do this 3 minutes. Yeah, 26th. Now you see there's an error because I am opening this indicator on a Bank Nifty chart. So what you need to do is Bank Nifty, this is like 56,600 yesterday. This one is like 100. Yes. Oh, this was 100, right? So yeah, 100 is okay because if I press the replay, it will take just 100 bars. Here, yeah, we are on. We can start from today morning. I will just run it fast so that you can see how this functions. Yeah. Very strong put selling. Bum. I'll just take a moment out here. Before this massive move came, do you see this massive put selling which has taken place out here? Congestion, breakout of congestion, and huge put selling in these two bars, and market never came down. This is another single bar congestion with a massive put selling. Then the market went up. So you will see whenever Nifty or Bank Nifty goes up in a major way, prior to that there has been always selling on the opposite side. That is, if market is going to go up, there has been put selling. If market is going to fall, there has been call selling. Let us proceed. Again, very strong. Wait. So before the market again went up here, there has been strong put selling out here. Practically no call selling. You see this, right? That brings us to an end of today. But I hope you understand the concept. So just two indicators. One tells you which time frame you will trade, what the regime is, what the volatility is, and this one tells you whether more calls or more puts or more calls are being sold. It tells you what is the ATM. It tells you what the PCR is doing, and the PCR analysis is totally based. This particular blue line is basically your PCR. I need to load 1,000 bars to see everything, but keep it 100 when you are actually trading. The indicator will load very fast. Yeah. Yeah, so what I was trying to say was, before any major move, see where the options flow is coming on. So that is why it is known as an options flow engine. So this is the system, and I hope even if you do not take the system, you have understood what scalping is. So, and if you have seen these indicators, it does not have any relation to what has happened in the past. It is absolutely concentrating on what is happening now. For example, these indicators which you are seeing are not based on any moving average. It's absolute option flow on this particular bar. It has no relation what has happened. Forget 26 bars even to the previous bar. Okay, so this is how the system works. You don't have to see n number of things to make a trade. बॉक्स आया, इंडिकेटर बॉक्स को ब्रेक डाउन किया, बॉक्स का ब्रेकआउट किया, इंडिकेटर कुछ बोला, साथ में ट्रेड हो गया. स्कैल्पिंग इज लाइक दैट ओनली. सो जस्ट दिस टू थिंग्स, decisions, you can go for scalping. So this brings me to an end to this video. I hope you enjoyed it as much as I enjoyed making this. So thank you. See you again sometime later. Bye.